This week, we got the CPI report, the jobs report, and a wave of retail and restaurant news. And all of it is telling us the same thing. We are living in a two-speed economy. One group of consumers is doing just fine, and the other is struggling to hang on. And if you're a retail real estate investor, that split is now showing up in your tenant mix, your leasing pipeline, and your underwriting. Welcome back to Retail Weekend Wrap Up. I'm Ray Kang, and every week we break down the economic and retail industry news that impacts your investments, your tenants, and your bottom line. So let's get into it. So let's start with the macro picture. What's happening with the US consumer right now? And this week, we actually got a lot of data. So let me walk you through it. First up, the big one. The January CPI report dropped on Friday, and it came in better than expected. Annual inflation slowed to 2.4%, down from 2.7% in December. And that's an 8-month low. Monthly prices rose just 0.2% versus the 0.3% economists were expecting. Gas prices fell. Egg prices dropped 7%. And here's the one that matters most for real estate. Shelter costs, which make up over a third of the CPI, rose only 0.2% for the month, bringing the annual shelter increase down to 3%. And that's a meaningful moderation. Now, it wasn't all good news. Airfares jumped 6.5%. Appliance prices spiked, which economists are pointing to as evidence of tariff pass-through to consumers. And the Fed is still holding rates because core inflation is at 2.5%, still above their 2% target. But the direction is encouraging, and this report did boost expectations for potential rate cuts later in 2026. Next is the jobs report. We finally got the January numbers on Wednesday after the government shutdown delayed it, and the headline was a relief. 130,000 jobs added, beating the 55,000 forecast. Unemployment ticked down to 4.3%. Healthcare and construction led the gains, and markets liked it. But here's what didn't make most headlines. The Bureau of Labor Statistics also revised all of 2025's job numbers, and the revision was pretty ugly. Total jobs added in 2025 went from 584,000 down to just 181,000. That is an exceptionally weak year by any standard. And for our world, retail, trade, and leisure and hospitality each added only about 1,000 jobs in January, basically flat. So the headline beat was nice, but the underlying picture for retail-facing employment is soft. And this brings us to the theme of the week, the two-speed consumer. Payments published a piece this week that lays it out pretty clearly. Bank of America's February consumer data shows high-income households posting 2.5% spending growth year over year. Low-income households, 0.3%. Middle income, 1%. Moody's Analytics says the top 10% of households now account for nearly half of all consumer spending. That gap has never been wider. Delta's CEO said it out loud this week. The strength in the consumer sector is at the higher end. The lower end consumer is struggling. PepsiCo cut snack prices up to 15% because their consumers told them they're feeling the strain. So when you see headlines that say consumer spending is resilient, it is, but it's being carried by the top. And if you own retail real estate, you need to know which consumer your tenants are serving. Finally, on the economy side, we also got the delayed December retail sales data this week, and it was a surprise miss. Retail sales were completely flat in December. Economists expected a 0.4% growth. Furniture stores, electronics, appliances, all down. Even restaurants dipped. But before you hit the panic button, NRF Retail Monitor showed January retail sales were up 0.2% month over month and 5.7% year over year. That's the fourth straight month of gains. So December looks more like a holiday hangover than a spending collapse. The consumer stumbled but got back up. And the question is how long they can keep that up with sentiment at its lowest level since 2014. Now let's shift to what's happening inside the retail industry itself, because this is where the rubber meets the road for commercial real estate. First, Eddie Bauer, the operator of about 100 80 Eddie Bauer stores in the US and Canada filed for Chapter 11 bankruptcy this week. This is the brand's third bankruptcy in just over 20 years. They cited declining sales, supply chain problems, tariff uncertainty, and inflation. They had only about $20 million in cash against $1.6 million a week in operating costs. Liquidation sales are already underway, and unless a buyer steps up, all stores will close permanently. Now, Eddie Bauer is mostly in malls and outlets, so the direct strip center impact is limited, but the signal matters. This follows Saks Global filing Chapter 11 in January and closing most of its off-Fifth locations. Amazon shut almost all of its Go and Fresh stores this month. Specialty retail brands that didn't evolve their physical store model are getting weeded out. The silver lining for retail real estate, the bankruptcy wave of 2024 and 2025 freed up space that value and experiential tenants are now absorbing, and available supply is tightening because new construction has been so limited. Yum Brands announced on their earnings call this week that they're closing approximately 250 Pizza Hut locations in the first half of 2026. That's about 4% of the U.S. system. They're calling it the Hut Forward program, targeted closures of underperforming stores combined with marketing investment and tech modernization. So Yum is conducting a full strategic review of Pizza Hut that could result in a sale of the entire brand. U.S. same-store sales fell 5% in 2025, while Domino's posted positive comps. Meanwhile, Taco Bell, also owned by Yum, had same-store sales up 7%, so Yum isn't struggling, Pizza Hut is. For commercial real estate investors, this matters directly. Pizza Hut locations are typically 12 to 2,500 square feet, freestanding pads or end caps in strip centers. Those are prime spots, and when those go dark, they tend to get re-tenanted quickly by expanding QSR concepts. Think Raising Cane's, Dutch Brothers, Wingstop. And if you have a Pizza Hut tenant in your center, now's the time to evaluate your lease exposure and start having conversations about what comes next. Darden Restaurants, the company behind Olive Garden and Longhorn Steakhouse, announced this week that it's shutting down the entire Bahama Breeze chain. 14 locations close outright and 14 will be converted to other Darden brands. The ones closing will operate through early April. This is actually a positive story for retail real estate. When a strong operator like Darden closes an underperforming brand but converts the sites to better performing concepts in their portfolio, the space stays occupied. The landlord doesn't go dark, Darden isn't leaving those centers, and they're putting a stronger brand in the same box. That's the kind of portfolio management we want to see from restaurant operators, and it's a very different outcome than a bankruptcy liquidation. And finally, the big picture for restaurants. The National Restaurant Association's 2026 outlook projects the industry will hit $1.5 trillion in sales this year and add over 100,000 jobs. That sounds amazing, but analysts are calling it a humbling year. Traffic growth is expected to be less than 1%. Food costs are rising, especially beef, and supply chains are still disrupted by tariffs, and operators can't raise prices much further without losing customers. The brands that are winning are the ones taking market share. Raising Cane's, Wingstop, Chick-fil-A, Cava. These are the tenants that are signing leases aggressively and paying above market rents for prime strip center locations. But weaker casual dining concepts are under real financial pressure. As a landlord or investor, you need to be watching your restaurant tenants' health very closely in this environment. The strong are getting stronger and the weak are getting weaker. So what does this all mean if you're in retail real estate or looking at commercial real estate investments? I've got 3 takeaways. Number 1, the two-speed consumer or K-shaped economy is not just an economic headline. It's a tenant strategy. Centers anchored by necessity and value, grocery, discount, healthcare, QSR, are positioned to outperform because they serve the consumer who's still spending, whether they feel good about it or not. Centers heavy on discretionary and mid-tier retail are the ones facing the most risk right now. Know which consumer your center serves and underwrite accordingly. Number 2, CPI at 2.4%, shelter costs moderating, and a better than expected jobs report. That combination puts us on a path toward potential rate cuts later this year. We're not there yet, the Fed is still holding, but the direction is still right. For commercial real estate investors, that means the cost of capital may start easing, which directly impacts deal activity, cap rate compression, and buyer appetite. And if you're thinking about selling a well positioned asset, the window may be opening. Number three, the reshuffling happening in retail and restaurant right now is creating opportunity. Eddie Bauer, Pizza Hut, Bahama Breeze, Saks Off Fifth. These are all spaces coming back to market, and new retail construction is still extremely limited. Analysts have called it a dwindling supply environment. If you're a landlord with good locations, you're going to have options. Value retailers, fitness concepts, medical users, and fast growing QSR brands are all competing for space. The key is being proactive. And that's your retail weekend wrap up for the week of February 9th, 2026. If this was all helpful, make sure to like, subscribe, and share it with someone in the business who needs to hear this. Also, links to every article I referenced are in the description below. Drop a comment and tell me, are you seeing the two-speed consumer and the K-shaped economy show up in your markets? Which tenants are winning and which ones are struggling? I want to hear from you.